Hello, everyone, and thank you very much for joining us for this week's Nasdaq Dorsey Wright podcast that is going to be airing the Friday of February 3rd. My name is Ian Saunders, and we are thrilled this week to be joined by Brendan Ahern, who is with KraneShares. So, Brendan, I know that you've been on some of the media we've had in the past. We've had some webinars. You've been on the podcast. Actually, you sat here in this room, I believe, if I remember correctly, and joined the podcast there a couple of years ago. But we're thrilled to have you back here. Thank you for making the time.
No, thank you for the opportunity. It's great to reconnect to you.
Yeah, absolutely. So, Brendan, I know people probably know who you are, but if you wouldn't mind, just for those that might not, just providing a brief kind of background, maybe on yourself, how you kind of got into the ETF business, and then KraneShares as well.
Yeah. So I had the good fortune of being hired by Barclays Global Investors back in the beginning of 2001 as they were rolling out iShares, their suite of exchange traded funds. So was a very one of the early employees of iShares, and obviously arguably one of the most successful launches in terms of asset management, and certainly then worked for BlackRock for a number of years. But certainly I ended up getting introduced to Jonathan Crane, and he articulated his vision about how China was migrating its economy to more of a domestic consumption story as opposed to export-driven manufacturing, but also providing more and more access into the Shanghai and Shenzhen, the second largest stock market in the world. And I just thought about it from an indexer's perspective that the historical definition of China was Chinese companies listed in Hong Kong. And when John said, wow, you got the second largest stock market in the world, you're giving more access, I just thought about, well, if we can own those stocks before index providers like MSCI and others own them, like we can front run the largest asset managers in the world. And so I quit my job to help make Jonathan's vision investable 10 years ago. And lo and behold, probably like many of your clients, as financial advisors, Ian, it was not an overnight success. There were trials and tribulations, but knock on wood, we're up to about 12 billion in aggregate client assets.
Wow, that's awesome. And it's always, the kind of startup story is always nice to hear that kind of background. But I'm sure it's certainly a pretty different market environment now for China than it was back then.
Yeah, I think there's always been risks or around China. 10 years ago it was shadow banking or ghost cities, and today it's maybe more geopolitical. But I think if you step back, I'm in my late 40s, and growing up in the 80s, there's this Asian country. Its economy was growing much faster than the U.S., and its companies were buying Rockefeller Center and Pebble Beach, and Michael Crichton wrote a book about how they were going to take over America, and Tom Clancy wrote a book about a surprise attack, and there was all this geopolitical concern, economic concern, and of course that country was Japan. And a lot of what's happening with China today, I'm just like, man, I've seen this before. It wasn't Japan, it was Japan then. But similarly, from a investor's perspective, Japan went from, became almost 2/3 of developed market indices. And, MSCI created Asia ex Japan in 1989. And I kind of, from an indexer's perspective, you see a similar path with China. And so a lot of what we're trying to do is, help investors navigate what's happening there. We're in finance, we're data people. And, this little thing is a mobile surveillance device. And, we get data from Chinese mobile payments and e-commerce companies. We don't need government data. And so we want to provide that perspective to investors and earn their trust. And I always point out, you might say you don't own China, but you do, because almost 20% of Apple's revenue comes from China, 25% of Tesla, more than 10% of ExxonMobil. U.S. multinationals have done a great job in China, and that's true for global multinationals. So you have this implied exposure to China, which is why you got to understand what's going on over there. And then you might want to own via KraneShares, some of the local equivalents, because they're probably doing well over there as well.
Right. And so given kind of all the integration, I guess, with the Chinese economy into that global economy and the various kind of some of the biggest US companies, like you just touched on there as well. I mean, just kind of diving into some of the nuts and bolts of what I think a lot of our listeners might be interested in is we saw a lot of underperformance from China over the course of the past year. I mean, it's been a rough 18 months to couple year period, kind of on the back of a lot of those COVID concerns and COVID issues, how they might have handled it a little bit differently. But I mean, in many of our rankings, Brendan, that we have on the Dorsey Wright platform, I mean, China fell to some of the lower levels that we'd seen on several of the rankings, like the asset class group scores page. And so, given that you are the boots on the ground and no better person to learn about it than yourself, why did we see such China underperformance relative to other areas and broader international and emerging market equities?
Yeah, I mean, big picture, stepping back, EM, and a lot of investors say EM in China is out of favor. That since the global financial crisis, this incredible underperformance, and so if I'm an advisor or I'm a trustee or I'm a board member, part of an investment committee, I mean, holy cow, 56, it's 14 years. We're talking about 56 quarterly meetings or calls explaining why we hold something that consistently underperforms and is a drag, right? The more we've diversified, the worse we've done, because U.S. equities have been the only game in town. But I would argue, one, that if we looked at MSCI emerging markets, MSCI China, 10 years ago, those two benchmarks were 50% financials and energy, and they were basically value proxies. And we went through a decade of growth investing decadence that those benchmarks were very poor transmission vehicles, because a growth sector like tech made up 11% of EM. In China, it was 2%. MSCI China 10 years ago was 2% China.
Wow.
So this fallacy of EM or China, you can't get performance. Those tech parts of those benchmarks ran circles around the S&P 500. But that's kind of what we at KraneShares want to give you, right? That's give you that growth exposure. And I can, if you email us at info@KraneShares, I can send you the data that proves this thesis out, right? In the short run, I think there's really been three issues have really weighed not just on the markets, but on China's economy, on consumer confidence in China, but also foreign investor sentiment. And those three issues are zero COVID, real estate, and geopolitical, like U.S.-China relations. And part of why these issues over the last 2 years really weighed was that as foreigners, the party Congress in China, you saw, okay, Xi got his third term. He put his buddies in the upper echelon of the government. But due to promotions, mandatory retirements in the Chinese government, every government official in China had to make sure that they have a job for the next 5-year political cycle. So all issues got put on the back burner. And I think huge amounts of stress built up on these issues. And now that the party Congress is over in October, it's just like a 180. That now you have this, we call it a policy pivot. And, zero COVID, gone. Real estate, they're backing these distressed property developers. I mean, the government's literally saying we're backing them. They want to get property prices up. Now, part of that is for economic reasons, that as the global economy slows, demand for exports from China will slow. So what are they going to do to support the economy? Well, it's not going to be the post-global financial crisis infrastructure boom, right? Debt-driven, bridges to nowhere ghost cities. It has to be domestic consumption. And zero COVID really weighed on the consumer, because if you're afraid you might get locked in your apartment, you hoard cash, you don't spend it. Mm-hmm. So some of this going away is due for economic reasons. And then on U.S. China, you had Biden and Xi meet for 3 hours at the G20 in Bali. At the APEC conference in Bangkok, Kamala Harris and other government met with Xi. Secretary of State of Blinken is on his way to China. Janet Yellen will visit China. And I think part of that is China's realized that its economy is so geared to the West, it cannot afford to be ostracized or excluded like Russia. And I think some of that is also true. The West does need China. That we need these things that are made in China, but also the profits that come from American and companies operating in China. So hopefully some of this is just people getting on airplanes, picking up phones, or doing Zooms. Because we need them as much as they need us. And there's some green shoots there from the political side. So again, part of what I think, your X's, the Dorsey, Wright, X's and O's are picking up on is, the alleviation of these issues on China markets.
Right. And I think we've certainly seen some of that. As I mentioned, like with the group scores page that I touched on, we saw China fall to some of the lowest ratings on that group scores, the average score perspective that we'd seen down kind of south of a 1.0 score. Score goes from 0 to 6. But recently crossed back above that 3.0 threshold, which is that kind of line of demarcation that we look at to identify the stronger areas. The higher the better, but when you're above 3 in the top half of those scoring ranges, it's generally a pretty good sign. And just in the past couple of weeks, it moved back above that 3.0 scoring threshold for the first time since the first quarter of 2021. So, I think we're definitely seeing some of what you just talked about play out from a relative strength perspective too. Taking the first part of what you just touched on there, though, I think the term reopening has been thrown around quite a bit, and probably has a few different kind of connotations with different individuals. So with reopening, what you said, zero COVID just kind of out the window. What does that look like right now? And I know there's talking about with more people being able to travel around, air traffic's picking up. But what is that? Are they completely open now, or what does that kind of look like? And what is it going to look like down the road, I guess?
Yeah, for domestic travel in China, they've opened things up, and you probably they have their big holiday, their Lunar New Year, and just a gazillion flights. And so on the international, the outbound side, it's still slowly getting there, but I think over the next several weeks you'll see. I think tourists from Asia are going to be all over. If it's here in New York or down in Washington near you, and after 2 years of being locked up, people are ready to get out and about. And what gets us really excited as investors, and it's self-serving and highly biased, is we think the e-commerce companies are the transmission engines for domestic consumption in China, and certainly online travel companies like Trip.com. These are companies that we hold within KWeb, and I just believe that as the global economy slows a little bit, manufacturing demand in China will slow. The trade data is showing that. And so there has to be a lot of emphasis on domestic consumption. And recently, President Xi did a big economic speech, and actually highlighted how many times he said domestic consumption. He just kept saying it over and over, because that's where they have to focus. And so there's a lot they can do to support the local economy by raising domestic consumption. And I just feel like, a lot of it's very interesting, Ian. Most of my conversations over the last several months have been with hedge funds, and hedge funds are traders, right? They don't marry their positions, they change. They're chameleons. And you contrast that with a lot of investors. The investment committee needs to meet, or we got to talk to the trustees or the board. And think about back in October, a big U.S. pension plan said we're going to cut our China position in half. Can you imagine what their Q1 investment committee meeting is going to be like?
That's a rough time to be cutting. That's for sure.
Hey, how did that call go? But think about, how do they reverse that? Does that happen? This underweight, it comes off, I think, slow. It's hard it's very hard to change for a lot of investors because of the committee nature. And that's why, my view is like the pain trade is higher.
Right.
Now, obviously, Dorsey practitioners, they're going to use, the methodology, right? And, it's reassuring to hear that a lot of our fundamental beliefs are kind of showing up in the charts.
Right. And I mean, that's what we feel is one of the beauties of the kind of technical analysis as a whole, or certainly point and figure charting, is that, I mean, it's completely objective, right? I mean, it doesn't take a political stance. It doesn't factor in everything kind of factors into the price, right? And so, I mean, we're seeing that play out, certainly from a near-term perspective. Just given some of the volatility, we do need like a little bit more consistency for some of the relative strength relationships. But that near-term strength is certainly kind of picking up, especially when looking. I know you mentioned like Trip.com and looking at some of these individual stocks. I mean, their technical pictures look pretty solid, and we're seeing some pretty strong pictures from some funds like yours as well. In taking a look at some of the individual stocks, though, I know that a variety of different ways that you can kind of hit on different stock pictures. One of the ways that we look at it here at Dorsey Wright is through participation readings. So looking at like the percentage of stocks participating in an upwards movement. So we have an indicator we track from the Shanghai bullish percent, looking at the percentage of stocks in the Shanghai exchange that are trading on a buy signal on their default point and figure charts in our system. And we recently actually, with movement yesterday, saw that indicator print a second consecutive kind of higher high, up at a chart level of 42%. So that indicator got up to 44% back in June of this year, fell back lower by the beginning of October, and then turned right back around and just swinging higher. Right around the kind of mid 40s is really the highest level it's been at for a couple of years. We're seeing it reach 44, reach 46 in September of 2021. But it's definitely kind of getting back up towards peaks. Do you think that maybe some of these stocks have been on too much of a run, or how far do you think that some of these can go?
Yeah, I mean, I think we kind of if you think about the K-Web companies are there's really two Chinas. There's the historical definition of China has been Hong Kong and US ADRs. So like K-Web is more, what do foreign investors think about China? And we can contrast that with KBA, because KBA is Shanghai and Shenzhen stocks, 95% owned by investors in China. So it's more reflective of why, what do the Chinese think about China? And in 2021, K-Web did not have a good year, unfortunately. I say that as a shareholder. But I was, and that was because of all these issues we kind of spoke about, it weighed on the space. But in China, Chinese investors didn't really care about that stuff. And so KBA actually went up in 2021. And that's why we kind of say like KBA and K-Web, even though they both have China in the name, because the end investors are so different, they're doing two different things. And I kind of view K-Web as like a coiled spring, where it's had a big move already. But I kind of say, you go around and ask people like, hey, are you buying Chinese stocks? Like, I don't think so. Pain trade's higher. Actively managed funds, particularly US funds, are highly underweight China. And that's despite the rally. At the same time, in China, as zero COVID goes away and they address real estate issues, the belief is that economic rebound is, animal spirits will lead to the mainland markets going up. And it's funny, I was looking at charts of Shanghai, Shenzhen, the composites, kind of KBA, and it looks pretty darn compelling. The problem is you put China on it, people are like, whoa. And that's where economically, if you think about, China has very low inflation, under 2%. The central bank is easing. Interest rates are literally dropping in China. They're quantitatively easing. They're putting, money supply is growing, and the valuation situation is reasonable. Now, if we think about other investment opportunities, is our interest rates going up or down? What's inflation doing? What's the valuations on a historical basis? I've got a little bit of a bias. just because I worked at Salomon Brothers Asset Management, and we had this ex-Fed official was a portfolio manager, and the only thing he looked at was money supply. Look at money supply in Europe, in the U.S., and Japan. It's so anyway. There's a lot of China's got a few things going for it, but the great thing again, Ian, is like what's great is like. The narrative or the media, like just forget it, right? It's let the charts tell you what's happening. And the positive thing, it does reaffirm a lot of what we see from an economic perspective, as well as some of the fundamentals, as well as some of these issues that have really weighed on foreign investor sentiment.
Right. And so China, seeing the kind of rebound coming back into play there, seeing that area pick up strength. As you mentioned, China's, quite a large portion of most broader international, certainly broader emerging market representatives now. We've seen some other emerging market areas that have held up relatively well, some areas in Latin America, like Mexico. But then also some Asian areas that have kind of picked up the pace a little bit more recently too. Do you think that the China trade is really kind of having a catalyst, or is really kind of taking effect in some of those yet? Because it did seem for a little while, during the underperformance, that it was weighing down a little bit more. I guess we would expect to see the opposite take effect now, right?
Yeah, I think we spend a lot of time looking at how are active funds relative to their benchmarks, or what are they over underweight? EM, global mandates, Asia ex Japan, and it is interesting. They've been very underweight China, so they've been overweight India. And we kind of see that maybe there's a little bit of a rotation, that this part of the pain trade is higher thesis is as China continues to outperform, it kind of forces managers back into these names. I do think the reopening of China has a benefit for commodities. That yes, this reopening of China, it's not going to be the debt-driven infrastructure boom, which was a huge for commodity plays in the late 90s. But certainly demand for things like oil is going to be very strong. And that's good for places like Colombia, right? It's good for Saudi Arabia. It's good for, so there is a commodity element that is, it's going to be good for a lot, obviously, Pemex, right? The Mexican oil company, right? That there is this commodity play within EM that, I think they'll be beneficiaries, right? A lot of these holidays that the Chinese just took, it was to Indonesia, so there's an effect, right? That will take place. And I think just in general, I just think, I just find it interesting, I'm watching like financial TV, like, everything's about Tesla and Apple and Google. And I'm just like, man, what worked in the past 10 years, are you positioned if it doesn't work for the next 10? And,
yeah.
We'll find, time will tell, I'm not, I don't even pretend to think I can predict the future, but, the market tends to do what's least anticipated. And, certainly, the dollar is a big thing to watch, as it declines, maybe non-US equities goes on a nice run here.
Yeah. And that's what across many of our rankings, broader asset class rankings that we have on the system, international has kind of risen to the top of most of those rankings. And the China trade recently has certainly provided some tailwinds to kind of continue to push that area higher. Every time it seems like, some of these areas are getting a little bit overbought, a little bit pullback, and then they just kind of continue to stair step higher. And so that's certainly been the case in many areas that we've seen on the system. So it's nice to hear that the fundamental side of it's kind of playing in with the technical side too, kind of coming together to, as Tom Dorsey would say, play the piano with both hands, right?
100%.
Well, Brendan, I guess what's one area or one kind of indicator or thing that, or chart or reading or something that listeners can kind of look toward in terms of continuing to see some of this move higher, maybe not on the technical side, but on more the fundamental, or what are some numbers that you've been following or something that we can kind of continue to track here?
Well, I think, we're headed into the Q4 earnings season for a lot of the companies within KWeb. And I think the market in February will be very focused on their forecast, that that Wall Street economists actually believe retail sales will be negative for Q1 in China. And I think some of the things we're seeing from the Chinese New Year, the travel, the spending, what if that's positive? So I think investors, the potentially next real catalyst will be, the Q1, Q2 forecasts could give us that next leg higher against this backdrop of underinvestment, right? That pain trade just getting harder. The one thing I always point out to people, just one little nugget of us staring at China markets for 10 years is I always watch CNH. So CNH is China's currency during U.S. trading hours. And if you think about it, it's very easy to move a stock. I can push Apple down for a nanosecond by, selling, right? But currencies are much harder to move. And CNH is a great barometer of headline risk. And so I always say to people, before you panic or you see something in the news, check out CNH. And I think part of what's I found kind of interesting, kind of on your point, these dips being bought is when you get these pullbacks in China, CNH is staying very stable. It's actually appreciated really strongly versus the dollar. It's kind of fascinating. And then that's why these dips, I'm kind of okay, this dip can be bought because of what CNH is telling us, that if some of this headline that creates the dip, CNH is saying it's not something I should lose sleep over. And then these dips get bought. And it's kind of an interesting little nugget that I just kind of keep up on my screen is watching CNH. And it's something that, for the folks, the Dorsey practitioners, it's something kind of interesting to follow.
Yeah, absolutely. That's certainly, we had the kind of point and figure chart of that relationship with the US dollar that people should I'm certainly going to add it to my chart list. It's something I'll take a look at there each morning and keep up to date with. Well, Brendan, I think that kind of runs through most of the questions that we were looking to touch on here. And again, I know you covered a few different ways that you can kind of access information via the KraneShares.com. I know you're also the author of China Last Night, right?
Yeah. I write a daily research blog, and it's just it's quick, it's easy. Should you read it every day? Probably not. But when
I read it every day, so that's
I'm blushing. My mom doesn't even read it every day. But there's going to be a day where you're going to see something, a headline, and if it's in your inbox, you just open it up, and it gives us the venue to kind of respond to some of this stuff. And again, so ChinaLastNight.com, it's a free research blog. And then certainly on KraneShares.com, we produce a lot of work, and we're always available. I think, like yourself, Ian, customer service is job one, and we're on planes, trains, and automobiles, and always available just via info@KraneShares.com.
That's great. And for those that are subscribers to our research platform as well, we do have a model that we partner with KraneShares on, looking at identifying focused relative strength in China, kind of an offense defense type of model that's going to move into areas or move into the funds where we see relative strength pick up the pace. We've seen that model move back into a little bit more offensive posture here recently, and certainly will be something that we'll be continuing to monitor here over the weeks and months to come. But any more info on that, definitely can reach out to us or KraneShares on that front too.
Yeah, I think Ian, the model said, you should be, for 2 years almost, the model was basically significantly underweight equity exposure. And, for us, that was kind of a bitter pill, but again, it worked. And then to see it, seeing the offense come back on the field was been definitely reassuring.
Yes. And it'll be good to see that offense continue to come back on the field. Hopefully, as we see some of these other indicators and indexes continue to climb. Well, Brendan, it was great to have you on here. Thank you for joining us here again. And for those that are listening, thank you for tuning in. Please do reach out to Brendan there with KraneShares if you have any other questions on that front. And we look forward to having you back next week.
Thank you again, Ian.